All right. Today is Tuesday, December 20. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And oh, the weather outside is frightful. It's actually not that frightful here in the West. And if you look at the forecast, according to Fox, they say a huge part of the country is going to have a white Christmas. So I guess here in the West, we're going to have, a Hispanic Christmas? A little spicy, a little warmer than usual, I guess. It's going to be in the 70s here. Not that I mind, of course. Now, let's start with this. My apologies for the absence yesterday. Your boy has been traveling a lot as of late, sometimes doing 2-3 cities in a single day. And I know a lot of you say, hey Maverick, have a good time, as if I'm in a vacation. Not really, I've been working my ass off. But the beauty of traveling is you get to hear what's going on in the country and other places. You get to hear more stories, more reflection about the economy and inflation and all of that stuff. And what I noticed, and perhaps this is just anecdotal evidence for now, but what I noticed is my flights are all less full than usual, I guess. I'm not saying this is an indicator that demand for airline traveling is going down. I'm just saying this is my anecdotal evidence. And since most of my business and my affairs, and by the way, by affairs I mean work affairs, not, having a side check, just in case my wife is listening, but since most of my business and affairs are in the Southwest, I do fly Southwest. And the beauty of Southwest is you get to choose your seat. No assigned seating here. And I learned perhaps a travel tip if you're traveling Southwest, because throughout all of my flies since the weekend, I had the entire row for myself. First class, baby, without paying the price. And the trick is, once you sit down and the passengers are walking through the aisle, you start giving them dirty looks. Just make weird eye contact. And they'll say, okay, this guy's crazy, not sitting next to him. But don't overdo it with the dirty looks because somebody might feel threatened in this day and age, and they might kick you out of the plane. So take it easy. But last time I had somebody sitting next to me, I'm having the window seat, I'm looking outside, minding my own business, and the guy next to me is like, hey, look at this. This is evidence that the earth is flat. So all of a sudden I got a flat earther sitting next to me. And I'm like, sir, you gotta be Stevie Wonder not to see the curve. It's a sphere. You can see the curve. It's clear. But he keeps going on and on and on, trying to convince me that the earth is flat. And I go, okay, if the earth is flat, then when the sun rises, it has to be daytime across every single place on the planet because it's flat. And he goes, no. But earth is bigger than the sun. I'm like, okay, this guy, sir, you're out of your mind. Please leave me alone. I'm minding my own business. Go to sleep. Goodbye. But anyhow, besides the travel tips that I'm giving you right now, what's going on with the market? What happened to the Santa Claus rally? Santa rally? Anybody? Anybody Santa rally? Where's the Santa rally? Because for now it appears that the Santa rally went kaputs down the toilet, baby. But here's the good news. We're gonna have a Santa rally. The question is it gonna come in the next couple of days? And then we flush down after Christmas, or we get the Santa rally after Christmas. Meanwhile, we get a flush down in the next couple of days or so. And the Santa rally lasts all the way till New Year's Eve, and then down we go in the next year. Which one is it gonna be? Well, the folks at Forbes say that research in the Journal of Financial Planning found U.S. stocks have historically outperformed between Christmas and New Year, on average offering a return of around 1% for the final 5 trading days of the year and the first 2 trading days of January. So I guess you're going to start jerking off for 1% rally now after we're down 5%, 6% in a few days? We have further more downside to go. I mean, when you think of Santa, he doesn't look like a bull to me. He looks like a bear. He's stocky, he's fat. I don't know if you can say that anymore or not. He got weight issues, I should say. He dresses in red, not green. I don't know. He looks like a bear to me. So I don't understand the whole fuss about the Santa Claus rally being bullish for some reason. And even in this article, there's the fine print. And the fine print says, limitations on the Santa Claus rally. Of course, the effect has not worked each year. And outside of the US, especially in non-Christian countries, the results are more mixed. Specifically, the chance of an up day for the S&P 500 during the period is 62% based on history. This implies that the chances of the market rising during the holidays are higher than average. For comparison, the chance of the S&P 500 rising on any given day is 53%. Now, let's do all of these ratios in a bear market. They're not going to tell you that. That's the other fine print. But here's the problem, folks. Just when you thought they shot everything at the market right now, we got all of the bad news out of the way. Hold your horses. We got more bad news for you. Not if you're a bear, like Santa, of course, but if you happen to be a bull believing in all of this pivot crap, well, I got more bad news for you. And here it is. In focus tonight. Surrender. The Bank of Japan surrenders to inflation and says, okay, we're done here. We can no longer do it anymore. What are we talking about here? We're talking about the trade that is called the widow maker, which is basically betting that the Bank of Japan at some point will stop the deflation policies. Every single trader, even the most seasoned ones who bet against the Bank of Japan, well, they got slaughtered, and hence the name, the Widowmaker. But the Widowmaker is no longer, because today in the morning the Bank of Japan shocked the world by changing its stance regarding yield curve control. Here's your pivot. You're looking for a pivot? Here's your pivot. And it ain't the kind you're looking for. You see, the Bank of Japan has been fighting reality, because inflation is a global phenomenon right now. Inflation has always been a monetary phenomenon, specifically by the Federal Reserve of the United States, aka the global central bank. When the Fed unleashed the tsunami of liquidity, trillions and trillions and trillions of dollars in response to the Thing crisis, guess what happened? Commodities prices shot up higher. And while the consumer behavior in Japan is not inflationary, it doesn't matter. They have to buy commodities using the US dollar. They have to buy oil, gas, metals, grains, all at the market price determined by the Federal Reserve. And it's reckless policies, shall we say. And therefore, inflation has been rising in Japan, way above the estimates of the Bank of Japan, way above the targets that the Bank of Japan has been setting so far. And naturally, the response by central banks to rising inflation is to tighten the monetary policy, reduce the money supply to take inflation down. But Japan has been facing a deflation problem for a long time until now. And the BOJ decided to fight the reality by continuing its quantitative easing policy. And as we've seen Japanese bond yields rising higher in response to higher inflation and the assumption that the BOJ at some point will have to tighten the policy, reduce bond purchases, and push yields higher. And traders across the globe want to get ahead of the game by shorting Japanese bonds, by dumping Japanese bonds, assuming that yields will go higher and that the will of the Bank of Japan will be broken. But the BOJ fought back by increasing its purchasing programs of bonds, specifically those at the higher end of the yield curve. In other words, this is yet another stimulative policy known as yield curve control. And everybody who bet against the BOJ got killed because they kept buying bonds over and over and over, and hence the Widowmaker. But all of that changed today with the announcement of pretty much the end of the yield curve control program. Now, they tried to be diplomatic about it and not freak out the market by announcing that exactly, but we all know where this is heading. In response, of course, the Nikkei went down by over 2% and the Japanese yen shot up higher. The Bank of Japan caught markets off guard by tweaking its yield curve control policy to allow the yield on the 10-year JGP to move 50 basis points either side of its 0% target. In its policy statement, the BOJ said that the move is intended to improve market functioning and encourage a smoother formation of the entire yield curve, while maintaining accommodative financial conditions. No, sweetie, you can't have it both ways. Either you're tightening or you're keeping accommodative financial conditions. You can't have it both ways. And this is the first time when the BOJ is losing against international traders. Mr. Kuroda, the head of the BOJ, shocked the world and announced the end of this program effectively. And again, he did not say that exactly, but the writing is in the wall. For one thing, look at this chart. It is of perfect correlation. In white, the 10-year yen swaps. In aqua blue, I guess, the 10-year benchmark Japanese bond yield. They're supposed to trade hand in hand. But since the BOJ intervention by putting a yield cap at 0%, the correlation is no longer. But now, when they announced that they're going to up their target, all of a sudden we have a shot up higher in Japanese yields. And we have a massive catch-up ride here in front of us. Now, you think this is going to happen amicably? You really think that this is going to happen, the catch-up trade, without insane market volatility? Well, think again. Look at the Japanese yen shooting up higher. And again, I've been accumulating a position in the Japanese yen since late summer. And I know I've been way too early. I get it, but the trade is going to pay off. The U.S. economy is heading into a recession along with the global economy. We will see a lot of demand for the Japanese yen versus the dollar, which is, by the way, within itself a massive seismic change. More on that in a second, but here's more evidence for you that despite what Mr. Kuroda said, that this is just a smooth transition while keeping accommodative stance. Bullshit. Look at the bank index in Tokyo, shooting up higher. Why is it shooting up higher? Because the assumption from now on is Japanese bond yields are going to shoot up higher, way above the BOJ's assumptions. And again, that comes with a lot of volatility, not just in the Japanese market, but in the global market too. Now, when we talk about the seismic shift, the announcement this morning by the BOJ pretty much ended the Widowmaker. It ended years and years of deflationary policies by the BOJ. It ended years and years of accommodative policy by the BOJ. But here's another seismic shift that's coming with this move. As the yen appreciates, the dollar goes down. And Economics 101, when the dollar goes down, the value of commodities appreciate. In other words, if this continues with the yen shooting up higher and the dollar moving down, we will see commodities prices moving higher. Perhaps not all of them. Perhaps we have a lot of headwinds against energy, for example. But metals are going to appreciate. That's inflationary. Grains are going to appreciate. That's also inflationary. In other words, the move by the BOJ this morning could unleash global stagflation. We see the global economy heading into a recession, yet commodities prices stick higher. Something to keep in mind. And here's the conclusion. Yield curve control is approaching an effective end if a wider trading band is the BOJ's way of normalizing policy. And this is according to Tanaka Matsuzawa, the chief strategist at Nomura Securities in Tokyo. He also adds, market volatility will only rise further. Bingo, bingo. And here is what economist Mohamed El-Erian says about all of this. Take a listen.
There's a ton we need to work through. The question I've asked all morning, and you've heard me ask it, so let me ask it of you. Do you believe this is a step towards normalisation? Or is this the BOJ, and that's what they're trying to signal communicate this morning, basically resetting policy on a more sustainable path? They're very different things. Which one is it?
It's absolutely the former. There's no doubt in my mind that this is the step towards normalization, but they're trying to make it a really long process, as unexciting as possible, so that it doesn't force selling by Japanese institutions. That's the big risk. And they've learned it from what happened in the UK. They've seen what happens in the UK when you shock the government bond market. When people have already optimized a low-yielding environment, they don't want this to happen. So yes, this is the beginning of the process. The genie's out of the bottle, whatever you want to call it, right? You've heard that phrase all day, but it's going to be, they're going to attempt a very slow process.
And again, he stresses the point that the BOJ is attempting to make this as amicable as it can be. The problem is it's not gonna. What we saw from the volatility in the decisions by the Bank of England could be repeated here with the BOJ. We talked about the seismic shift of ending the deflationary policies, also known as Abenomics. We talked about the dollar going down against the yen and the ramifications of that being inflationary. Now, of course, the Bank of Japan governor, Mr. Kuroda, is known for shooting bazookas, but these bazookas are usually bullish, usually by loosening the policy more. But we know that his tenure is coming to an end. And now who's going to take his place? We have perhaps a more dovish stance, and this is of the deputy governor, Mr. Amamiya. Or is it going to be perhaps a little more hawkish? And this will be contender Hiroshi Nakaso. Now, for me, it doesn't matter because they're not in control. See, this is what you guys and a lot of analysts and experts miss. They put a lot of weighting on what the Fed is going to do, what the Bank of England is going to do, what the ECB is going to do, what the Bank of Japan is going to do. These fools, these clowns, the cabal of central banks, they're not in control anymore. Inflation is. It doesn't matter if the next governor of the Bank of Japan is dovish or not. It's not up to them. They will be forced to act and conduct policy based on what inflation determines. And with the dollar going down, that's inflationary. We'll see how commodities prices are going to stick. But if they do, we have a stagflation crisis, perhaps a global one, right around the corner. Now, the other seismic shift regarding this decision is the tsunami of liquidity that is about to take out of global markets all the way back into Japanese markets now that we're having yields appreciating higher. In that particular country, of course. When we look at Japanese investors' equities and bonds holdings as a proportion of the GDP, an insane amount is in international markets, be it in the US, in the UK, in the Netherlands, in Canada, Belgium, doesn't matter. If you're going to tell Japanese investors investors that yields at home will be better, it will move higher, and the Japanese yen is about to appreciate, they're going to take billions, if not trillions of dollars out of global equities and global bond markets, and this will come with an insane amount of volatility. The bottom line from this move that we got today is volatility is here to stay. Santa Claus rally, no Santa Claus rally, doesn't matter. Volatility is here to stay. And the move that we saw by the Bank of Japan will be added to by even more hawkish policies. It is just a matter of time, folks, so buckle up. And with that, folks, let's move on to the coverage of the stock market, and we begin with the closing of the indices today, and here we go. We have flattish activities across the board. The Dow Industrial Average up by 92.20 points, or a gain of 0.28%. The Nasdaq pretty much in the flat line, up by 1.08 points, or a gain of 0.01%. Likewise, the S&P 500 almost flattish, up by 3.96 points, or a gain of 0.10%. When it comes to the sector's performances today, number one, capturing the gold medal, energy. We talk about the Bank of Japan pushing the dollar down, that's inflationary. All of a sudden, energy comes back. And at number two, capturing the silver medal, guess what? Another inflationary trade of materials. At number three, yet again, appreciating when yields move higher, capturing the bronze medal. At number three, financials. The market has spoken today. It is following the footsteps of the BOJ. The laggard of the day, consumer cyclicals. Again, supporting the stagflationary theme this time around, in which energy, materials, financials, and some of the defensive/recessionary, such as utilities and consumer staples, also tend to lead. Yet again, in this stagflationary theme, we see technology and cyclicals lagging the rest of the market and leading to the downside. When it comes to the advance to decline ratios, the NYSE 59% advancing versus 39% declining. The Nasdaq 50% advancing versus 46% declining. On to commodities, what's going on here? Well, the dollar is down, and therefore the majority of the action that we got today in the commodities market was positive. But we do have few exceptions here, mostly in energy commodities. Look at natural gas down yet another 8.5%. And of course, this is the volatile season for natural gas because it trades depending on the weather. And for now, we have warmer than usual weather, not just here in the United States, but most importantly in Europe. But could that change? The answer is absolutely. The season is still young. We're just starting here, and more volatility will come. With that being said, besides natural gas, lumber, lean hogs, the majority of commodities traded in the green, and the gains were led by metals. Look at silver, up over 5% in a single day. Okay, stop texting me. But we have palladium also up 3.5%. Grains up. Look at rough rice, up almost 5.5% in a single session. Again, the move by the BOJ will have seismic impacts, specifically on inflation and commodities markets. On to the options market, aka the big casino. What do we have here? At number one, the hottest table by far, and has been the hottest table by far for weeks now, TSLA, Tesla, aka the souffle. And the souffle is melting as we speak, down yet another 8% today alone, on the heels of losses of almost 17% last week. What's going on here is absolutely insane, and it goes beyond the stupidity of Twitter and Elon Musk. And my hunch is we have major margin calls underway right now as we speak, and it's pushing investors to dump Tesla shares by the millions. So any pop in this name, any rebound, and we have a rebound imminent. But this rebound is to be faded. Let it go for a little while. Maybe you want to join it, make a little bit of money, and then dump it right away and go switch back to the other side buying puts. We'll talk more about that in the charts analysis, but the volume for the souffle today was almost 3 million contracts, which traded today. About 54% of those were calls. At number two, Apple, with around 1.2 million contracts traded today. About 55% of those were calls. And at number three, Amazon, with around 725,000 contracts traded today. About 66.5% of those were calls. So we're seeing more call buying here, which could support a bounce, aka a Santa rally, perhaps before Christmas. And then after Christmas, down we go again. But it could be the other way. We could continue to go down, flush down all the way till the holidays, and then after we come back, we see the Santa rally pushing us higher by about 1 to 2%. If I had to lay a bet, I would say the former will happen, not the latter, but we'll see. Now, before we move on to the unusual activities, let's talk about the IV rank, which is the implied volatility, for a minute, since I've been talking about it for a while in the last couple of videos. When the IV rank surges higher, it means two things. The market is assuming bigger moves are about to happen, up or down, Number two, it means that the premiums for options are getting more and more expensive. So how do you use this information to trade one way or the other? Look at Nike, for example, the ticker NKE. The implied volatility is really high. It is at 78%, and therefore after hours we see a massive move in Nike. Now the implied volatility did predict that, perhaps did cause the excessive move in the after hours, but it also means that the premiums were really, really expensive. Meaning that call options holders for Nike needed a move of double digits to make up their buck, to flip these options for a small profit. Now here's the other thing. It also means that we will see fade the rip. Let's say Nike opens up 10-11% tomorrow in the morning. The likelihood is it's going to close a lot lower than that, which gives us the opportunity, if you're not in it, to buy some puts and catch the ride to the downside. Now that could happen in a day, that could happen in a few days. So if you're going to go with this trade of fading the rip and buying put options in Nike, give yourself a little more time. Don't buy weekly expirations because, in all likelihood, you're going to lose money. Even if you're right and the stock actually goes down in a fade the rip mentality, because the premiums are really expensive. So you might want to use calendar puts here to maximize your gains. On to the unusual activities that took place in the options market today. We begin with the ticker TSLA, Tesla. It is getting oversold. A lot of folks are loading up on calls. The timing becomes kind of important here. Are they going to get the timing right away? I don't know. So if you're going to play this move, you want to buy in increments. You want to buy right now, a little bit of calls. And maybe the stock goes down a little more and you buy more, but sooner than later, the move is going to happen because the stock is in severe oversold conditions right now. And somebody sees that happening and they bought the 145 calls for the expiration date December 30, with expectations that the souffle could move higher and gain more than 5% by the expiration date, and they paid around $4 a piece to enter this trade, all in all spending around $8.2 million. What about the ticker LYFT for Lyft? Somebody sees upside coming here and they bought the $11 calls for the expiration date January 20, with expectations that Lyft could add gains worth more than 6% by the expiration date. They paid around 65 cents a piece to enter this trade, all in all spending around $800,000. And then what about the ticker DKS for Dick's Sporting Goods? Somebody sees the name moving down sub 100 and they bought the $90 puts for the expiration date February 17th, with expectations that we will see a massive pull down here in DKS worth more than 17% by the expiration date. They paid around $2 a piece to enter this trade, all in all spending around $880,000. And last but not least, at the bottom of the table, what about the ticker MU for Micron? Somebody sees more downside coming for this name and they bought the 48 puts for the expiration date January 13th, with expectations that Micron could go down and lose more than 5% of its value by then. They paid around $1.40 a piece to enter this trade, all in all spending around $700,000. Moving on to the heat map analysis, what do we see here? Obviously, mixed picture, mostly in the green. We have some rebounds, some short covering. But again, you look at the outperformers, you have energy, you have metals. These are the kind of names you don't want to rally at this point if you're bidding for peak inflation, if you're bidding for a Fed pivot or cutting rates or pausing rates. But these names continue to rally because for now, the dip in the dollar means higher commodity prices and better margins for these companies in energy and metals. See, a lot of folks want to buy the dip in the dollar by buying some of the tech names, maybe the big caps. The problem with that is you also have a force of slower demand as the global economy heads into a recession, and I guess that could be applicable to energy too. But the major difference here is we have a commodity backing energy, we have a commodity or commodities backing metals. You don't have a commodity backing Microsoft or Apple or Amazon. So if you're going to bet that the dollar going down is good for something, you're going to go with commodities. But obviously, the notable underperformer, Tesla, down yet another 8%. Unbelievable stuff here. We also have Wells Fargo, and we have news for Wells Fargo. They got fined over $3.5 billion for being criminal pieces of shit. We also have UPS down along with FedEx, big time in the morning. Although FedEx managed to catch a rebound after hours when they reported earnings. This is a short covering rally. It's going to be faded right away. We also got a drop in GIS. This is General Mills in packaged food. The kind of name you want to be in during stagflation. The kind of name you want to be in during a recession. And of course, I'm talking my book here because I own the name. Today it was down over 3% after reporting earnings. I thought the report was good, but there are signs for concern here that at some point inflation is going to break the backs of even good companies with good pricing power. with good cost management. All of that is not going to matter if they continue to pay more and more for the input price. And on top of that, the demand starts to slow down. Hence, stagflation. And in stagflation, you're really not going to find any stocks you can play here on the long side. It's bad for everything. The exception, of course, some necessary commodities that we can no longer go without. Absent of that, stagflation is absolutely horrific. Even the recession theme at least has some clear winners. In the stagflation theme, effectively, there are no winners. Now, we have a lot of corporate news stories that I want to do for you, but due to the interest of time, since I'm recording this a little late, I just got here, we're going to skip these stories and cover them perhaps in tomorrow's program. So for now, we're moving on to the heat map for the ETFs. What do we see here? Again, commodities are leading the way, be it energy commodities, XLE, XOP, OIH, all moving higher. When we talk about metals, the XME outperforming today. We have a commodities rally as we've seen today. When we look at the international markets, the EWZ, the commodities giant Brazil, is moving higher. We see gold miners, GDX, a big pop today. The NUGT, we covered an options trade for this one not so long ago. Somebody buying calls. And here's what they saw from that trade, that NUGT will move higher, and indeed it did. Now, stick around for the charts analysis because I believe that the pop in gold will fade as we see the drop that we got in the dollar being picked up and we see the US dollar moving higher by a little bit, at least in the short run. And hey, why wait? Let's move on to the charts analysis right away. We begin with SPY, the S&P 500 30-minute chart. What do we see here? Not much. The meltdown continues, and it looks for now, at least if you're looking at this from a bullish lens, that the SPY found some support at 379.5, and it continues to hold on into that support. The problem is, if the bulls really wanted some insurance here, the chart should have rallied and caught 385 as support. It didn't. And that opens the possibility that we could see the SPY breaking 379.5 as support. And again, the Santa rally is going to happen. The question is it going to happen from 379.5 right now in the next couple of days or so? Or from a number below this one. And for that, we have to move on to the daily chart for the continuous contract for the S&P 500. And what do we see here? For now, the chart is bouncing from an important support of 3,855. And again, is it going to be the Santa rally right now or from a lower support, aka let's say 3,720.5 or 3,600? And then you get your Santa rally, a little pop, 1 to 2%. And down we go after that. Because look at the RSI, it is in negative divergence. Look at the MACD indicator also showing bearish momentum. And what if this is a formation of an ABC pattern? What if this B leg is the Santa Claus rally? And then down we go in a C leg all the way to perhaps 3,600, aka my June bottom. How about the Qs? The NASDAQ 30-minute chart. Similar story here. It appears that the Qs found some footing at around 269.29. Can it catch the Santa rally from this point on and perhaps get us all the way back to 280? Or is this going to happen from, let's say, 261.69 or further below? But the bottom line is this CPI euphoria sheep rally is now gone and erased altogether like it never happened. And here's the problem for the Qs. If we zoom in a little bit, the bulls would argue that yes, we found some footing at around 269.29 and higher we go in a Santa Claus rally. The bears would argue, watch out, this is a bear flag formation right now, and the 269.29 support would be broken. It's just a matter of time. To settle all of this, we have to zoom out to a daily chart for the continuous contract for the NASDAQ, and what do we see here? For one thing, the negative divergence in the RSI persists, and the negative momentum in the MACD indicator is here, and it is accelerating to the downside. But the good news is we have a rebound from the June bottom at around 11,058.5. This is a critical number to keep. If it is lost and we see a weekly closing below this number, it's game over. We're going to see a massive flush down. We covered that target in details on Sunday. If you're not a member, consider joining. It's only $10. And I know a lot of you, hey Maverick, you're charging too much. You're the same guy who just blew up 50 grand buying weekly expiration options. But when I ask you to support the channel for $10 so we can expand and hire folks and produce more programming, all of a sudden the calculator has to come out. Oh, let's see if we can afford this or not. Anyhow, a weekly closing will be really important. Above the June bottom, the hope is still alive for a Santa Claus rally. A close below the June bottom, 11,058.5, a lot of pain ahead. How about the IWM, the Russell 2000 small caps? This is a 30-minute chart, and again, below the important line of 174.22. The next support we have is 168.90, but the bulls are going to argue, look at this, could this be a reverse head and shoulder formation? Yes, it could. But tomorrow's action is going to be critical whether this reverse head and shoulder is going to play out or not. And if it doesn't, if you see early signs, that it's not going to work out this way, then down we go to 168.90. Here's the dollar index, and again, it was supposed to be a massive down day for the dollar, with the yen surging higher by 4% today? But the resiliency in the dollar is telling. Telling of what? Telling of the positive technicals. Telling of the bottoming of negative technicals in the Dixie. We're talking about the RSI bottoming. We're talking about the MACD indicator bottoming. All of this from a daily perspective. In other words, despite all of this pressure, all of these headwinds, the dollar is holding ground. In other words, what is the message here? The dollar wants to pop higher. Perhaps one last rally before it goes down again. And if that is the case, was the rally in gold today a fugazi? I would say it is. And sooner or later, down we go, and gold loses 1,763 as the dollar pops higher again. But the good news is, in the long run, the dollar is going to go down, and gold will make a U-turn and move higher again. Now, what about a daily chart for UK oil, Brent oil? What do we see here? Again, we're waiting for an ABC pattern, which should take us above 85, and that is an important support. Now it is resistance, but if oil bulls manage to close above 85 by the end of the week, that would be a major victory for oil bulls. A closing below, then we move on to the weekly chart, and what we see here is more negativity, a more bearish momentum. And here's the daily chart for the 10-year yield. What do we see here? We've been talking about the technicals, the RSI, the MACD indicators, telling us ahead of time that there is a pop coming in the 10-year. Perhaps it needed a catalyst, and now we got one. Perhaps the FOMC was not enough, and now we got the BOJ. That sealed the deal. We have a major reversal here in the policy. They're shifting stance to allow higher yields, meaning we have a rally on hand here, and as you can see, we have resistance coming. And you can see that clearly in the yellow line. Let's see how the 10-year yield is going to behave once it hits this line. Because when we look at the TLT, a daily chart, I've been saying if you've made a lot of money from the rally in the TLT, take some profits off the table, because the technicals are saying down we go. And indeed, the RSI is a negative divergence from the daily chart. Along with the MACD indicator, we have a crossing. We have bearish momentum, as you can see from the red columns in the histogram. All of this is indicating that the TLT will go down until it finds support. On the other hand, the weekly and the monthly charts are saying that the TLT will move higher after a pullback. In other words, the 10-year yield is about to move down again after a pop. And this is the recession. The market is predicting a recession ahead of time. How about the VIX 4 hours chart? What's going on here? Within a range, the support remains 20 and the resistance at 24.29. Honestly, I have no explanation here on why the VIX continues to be down with all of this uncertainty, with all of this volatility, actual volatility happening right before our eyes. Why isn't the VIX moving higher? That is the mystery. Perhaps we're not seeing a stampede to hedging right now. Perhaps we still have some complacency in the belief of the Santa rally. But as we get to the conclusion of the year and the Santa Claus rally doesn't happen, could we see capitulation and buying and a stampede of buying put options, pushing the VIX higher? That is certainly a possibility. What about Apple? 30 minutes chart. What's going on here? It got really oversold, and it found some footing in no man's land. The support remains 127.22 and the resistance at 134.37. I don't think Apple can really rally much from here. In other words, the weekly closing is really important. Let's say we get a bounce in Apple. Can it close the week above 134.37? If that is the case, then the bulls are still alive when it comes to Apple. But if they do close below 134.37 despite any rebound rally, any oversold rally, oh boy, it's a sign to double down on the puts, because we have massive downside coming here. Tesla, daily chart, what's going on here? It's a meltdown. It's catching a falling knife. You're standing in front of a tsunami of dumping. But the RSI is getting way oversold, hence we have a rebound coming. Now, my number is 130.77. Can we get there and then catch a rally? That will make me look good. But can it rally from this point right here? The answer is yes, because the RSI is severely oversold. We're seeing a lot of buying of call options. And if we see that combined with traders who've been buying put options, booking their profits, that could produce the pop right away. So for now, what is the pain trade? The pain trade is for those Johnny-come-latelys who are buying put options in Tesla right now. Too late for that. We have a pop coming. You might want to play that one first, then watch for resistance, watch for a rejection and a reversal, and then flip to the other side and buy some puts. And lastly, what about Bitcoin? What's going on here? A daily chart, again, consolidating within a bear flag pattern. Sooner or later, if the buyers don't show up and get us out of this bear flag pattern, Bitcoin will be down to 15,000 in no time. And with that, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the Consumer Confidence Index on top of existing home sales. And with that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
I don't want things to change.
But you can't stop the change, any more than you can stop the suns from setting.